And everyone, 209th meeting of the Tuesday, August the 2000. Call.
We will note for the record that all trustees but trustee Evans are present.
Can approve of committee meeting minutes.
So moved.
Second.
There is no comments by the chair. The internal audit presentation. All right, please.
Yes. So we have a presentation of the, we performed an audit, process review of the Division of Environmental Compliance, known as DC, industrial treatment area. We're going to use this presentation to go over the report if you guys want to start in your packet with that. We do have Jay Hoskins from DEC and Doug Mendoza over here to help with any questions. They were very helpful in the audit. They have a lot more technical knowledge than I do, but if you have any questions, they can help. So let's open up to slide 2. A little overview. So the Division of Environmental Compliance, or DEC as it's known as, was first established in 1988 in response to increasing the number of regulations and were occurring ever since the EPA had been established in 1970. I think at that point, management realized we needed a separate division to address all those regulations, and they set it up. So DEC is currently a division of the engineering department. It is located over at Bissell. They're on that treatment plant campus. There are 2 buildings that are dedicated to DEC employees. There's approximately 50 employees in DEC, approximately 15 employees in this industrial pre-treatment group that we're looking at. This particular area was reviewed last in 2017. I don't think any of you were here for that, so this is kind of a new area for you guys. There are 5 overall areas in DEC. If you move to slide 3, you can see the 5 different areas. I'll go over this quickly. Regulatory affairs. Now, the first 3 are grouped together. We did audit those in 2020. I think 3 of the trustees that are on our board right now were here for that one, for that audit. So regulatory affairs manages and oversees the environmental compliance for the district's various facilities. The stormwater unit, they oversee the activities related to what they call the MS4 stormwater permit. There's a permit for our separated sewer or separated stormwater system. And we were under that permit along with St. Louis County, and there's about 58 or 60 other entities that are covered by that permit. So we take the lead and make sure we're meeting the requirements of that permit, and that's issued by the state. And then there's the emergency response unit. They're responsible for investigating and addressing any instances in which untreated sewage leaves our system, the collection system or one of our plants. When we say we have a force main break, that's the unit that goes out there with operations and addresses it. By the very bottom, you see the lab group. It is what it is. It's a lab group. They support the other areas and along with operations. Now, industrial retreatment group, that's the group we're looking at today. They have their focus really is in 2 parts. There's the federal mandated industrial retreatment program that's required by the EPA. There are certain requirements that the industrial users or customers that are within our district have to meet. Their job is to make sure that happens. And then the second part is being, there's the calculation and maintenance of data for these industrial customers, and they calculate that and pass it along to our finance group for billing. All right, so as far as the overall scope on 4, again, this scope was on the industrial retreatment group, it consists of those 2 main areas I just mentioned. So the first area being compliance, which is that federal mandated program to monitor and ensure enforced compliance by those industrial customers. And they need to be in compliance with the EPA requirements, the Code of Federal Regulations, which flow down into the state's requirements, which flow down into our ordinances. Our ordinances basically reflect what's in the guidance above them. So the second area is what we call the cost recovery program. Again, this involves capturing and calculating, maintaining data for these industrial units. There are 7 different buckets there. Now I'll try to go over this really quickly. The first one is extra strength surcharges. There's an additional charge when an industrial user has excess concentrations in their discharge in our system. There's also reduction factors. That's actually a reduction in charges. That's where we calculate a factor to reduce the volume charged for non-sewered water on the bill. DC handles that. So then there's also compliance charges. That's a charge, it's a monthly charge based on the number of sample points and inspection requirements for that particular user. Then there's permit fees. If the entity basically is categorized as what they call a significant industrial unit, they have to have a permit. And so we charge them. They calculate it with the permit amount, and that's based on sample points and average daily flow. So then the next two are special discharge accounts. That's where an entity might have a discharge on site, and then they have to get permission, and then we have to go out and monitor and take readings on it to charge them for that. Special handling accounts are just a few offshoot accounts where there's special billing issues, and they handle that as well. And then you have all hauled waste activities. That's where we have approved waste haulers that come over to Bissell. There's a waste station at Bissell, and they basically hook up to our system and dump that waste in our system. We calculate the charges at the site or at Bissell. So, any questions on that? So all that information is calculated and captured and provided to finance. For testing purposes, we did look at portions of 2020, 2021, and 2022. Now, as far as the objectives in slide 6, again, we divided these into the two overall scope categories in slide 6. So the first one being the compliance. The district is basically what we are known as what they call a POTW, which is a publicly owned treatment works. So under federal guidelines, we need to make sure that we're meeting certain requirements under the CFRs, which involves identifying, classifying industrial users. There's different categories you can see in the middle of the page there. Now, those categories drive how many inspections they have to have, how often they have to be sampled, if they have self-monitoring, that type of thing. So these categories are really important. We also have, want to make sure the processing, issuing permits process was working properly, the monitoring process, reporting, enforcement. We handle enforcement as well. Now, slide 7, our ordinances are really the guidelines that drive much of this. Again, they reflect what's in the guidance above that, the federal guidelines and the guidelines from MDNR. We have the sewer use ordinance, which is about a 75-page ordinance. It's got a lot of good information. Actually, it's fairly easy to read. Then you have the required permits ordinance, and you also have the hauled waste ordinance. So, any questions there? Slide 8. The second part of the objective is the cost recovery area. So we wanted to make sure the process around these 7 different buckets or categories designed and implemented properly, which involves on slide 9, making sure the data is captured accurately and stored securely, calculations are performed accurately and timely, the data is communicated accurately and timely from DC over to finance. Slide 10, as far as our approach, again, broken down into those 2 parts. First thing we did was get a hold of all those requirements, the federal requirements, state requirements, and our ordinances, really kind of pour through that. We've done this before, so we had a head start from the last audit, but there's a lot there. We really spent a lot of time looking at that. And then we have discussions, meetings with Doug and his team, a lot of back and forth. They were very helpful going through these different areas. We did leverage our walkthroughs from the prior audit, which is very helpful. We had a good start on that from last time, so that helped our process. Slide 11, we did obtain access to the documentation in their systems. They use an industrial retreatment data management system called IPACS, and then there's also a lot of documentation contained in Laserfish, which is really the case for a lot of our areas now. We're using Laserfish for a lot of things. We did perform detailed testing of the process for classifying these various types of industrial units. As I mentioned, that's pretty important. We did test all the inspection and sampling and self-monitoring processes, and we did look at the enforcement process as well. And that's, the enforcement process involves an escalation process for really, so some cases it's just a verbal warning. In other cases, then you move from that to an NOV, you get an SNC, that's where you have a significant non-compliance letter. If you have that, then you're part of the advertisement that we advertise annually of anybody who has an SNC. So then there's also administrative orders. That's where legal gets involved. So we basically, if they don't respond properly, we turn their heat up until they do, basically. So in some cases, they take them to court. So slide 12. Cost recovery. Again, we did the walkthrough process around those 7 buckets. We did, talk about how they calculate charges and factors and so forth. We did have one opportunity improvement in this area, and we'll talk about that later. It's in the area of reduction factors. Again, slide 13, we did obtain, access to the documentation in the various system. For this area, we used the ECIS Plus a lot more. We looked in the billing system to see how things were resulting. So in regard to the 7 categories, we did review the support for the data and the calculations performed. We tested the accuracy and timeliness of the calculations, and we did follow it through all the way through to the billing system to make sure the end result was what we were expecting. So basically looking at it from cradle to grave, so to speak. Any questions there? So slide 14, as far as the overall result assessment, this went really well. We had a satisfactory opinion. The very nature of this area really requires that the group be very detail-oriented and very organized, and they are. They're exactly that. So we did have the one opportunity for improvement around the review and recalculation of reduction factors. So if we move to slide 15. So to remind you guys, the objective of reduction factors is to reduce the volume charge for commercial customers' bill for the non-sewered water. So basically, we want to bill only for the sewered water on the bill. You can see the formula up there above. We're just backing out really the non-sewered water. Some examples of that are irrigation, manufacturers using water in their product and so forth, cooling towers. Those are some of the main examples. So based on internal policy, reduction factors should be reviewed or recalculated by DC at least every 10 years. That's an internal goal. So it's not required, but I think it's a pretty good internal goal to have. So if you move to slide 16, you can see an example of what one of these looks like on bill. You look down there in the right-hand corner. You see this is a pretty big customer here. They have 15,600 CCFs as a volume for that month, but the reduction factor is 42%. So that brings it down to 6,500 CCFs. Excuse me. So then we charge based on that 6,500. You can see the volume charge in the right corner down there. Slide 17, what we noticed in our audit is they're a little behind reviewing some of these reduction factors. Now, I guess the one thing I should mention, some of these factors are looked at quite often. So there are certain big customers that actually looked at quarterly, and those customers do some of the legwork because they want to keep reviewing, and obviously they're trying to save money. So I think it's some of those smaller customers that.
You had a question.
Hey, Tom,
I'm sorry.
How big in terms of dollar amount is this whole the subject of these
Reduction factors?
Yeah, I mean, is it? Are we talking millions, hundreds of millions?
No,
millions, 100,000.
Again, one thing I can tell you is there's 1,100 customers that have return factors out of our 400,000, whatever. So it's not a very large group of customers. I don't know if you can help answer that.
I think Marion probably would be.
Oh, okay. Thanks.
Okay. Any other questions, guys? All right. So basically, as I mentioned, there are about 1,150 customers that have return factors. And so some of these customers they're looked at more often. They requested that way, and so I think there's somewhat of a backlog of some of these older ones, smaller companies. I think smaller customers, I should say. We identified that there were 171 reduction factors that had not been reviewed since 2011. That's based on the 6/30/2022 listing. 51 were last reviewed in 2011, 75 in 2010, and there's 45 that were really come from 2009, 2007. So since we did the last audit, we did see improvements in this area. There were about 250 accounts that were 2004 or older at the time of the audit. So they've really whittled it down, but there's still more work that needs to be done to try to eliminate this backlog and balance it between doing their current, the ones that need to be currently done. So to address this condition, we recommend that DEC take the following steps at slide 18. We just, keep the idea of addressing this backlog as a priority and continued efforts to ensure adequate resources are available to address the backlog. There's a balancing act, I think, going on, addressing the backlog and then addressing new requests and the ones that are done more often. But eventually we want to eliminate that backlog. Any questions there? So slide 19, the responsible personnel is listed there. They are in agreement with the recommendation. They've already taken some steps to address the condition by making changes to the process and related infrastructure. Ultimately, it's going to take a few years to fully eliminate the backlog, and we'll continue to monitor every year. We always follow up on these recommendations. Any questions? That's all I have. Well, thank you, everyone.
Next meeting tentative date, October the 4th, 2022. Motion for adjournment.
So moved.
Second.
Thank you, Trustee Nicholas. And we'll get the documents switched out. We'll be ready to, we can start as soon as that happens, so.
Good morning, everyone. Welcome to the 233rd meeting of the Program Management Committee, Tuesday, August 30th, 2022. Can I get a roll call?
We'll note that all trustees are present except Chairman Evans.
Approval of the committee minutes, August 2nd, 2022.
Second.
No comments by the chair. Rich with engineering.
Good morning, trustees. Agenda items that you guys will be voting on next meeting. First item is the Earth City Shoreline Pump Station replacement. This action will appropriate additional funds for an ongoing construction contract with Kelp Contracting. The work being done consists of the replacement of a pump station, approximately 305 linear feet of sanitary sewers, 10 to 54 inch in diameter. The purpose of the project was to replace an existing deteriorated pump station that reached its useful life. The project's expected to be completed this November. This supplemental appropriation is for $105,000, is required to complete the construction due to the additional costs related to poor soil conditions and the impact of dewatering in the Earth City area. The conditions of soil required leaving shoring in place and more substantial dewatering efforts than anticipated. This appropriation covers the cost of leaving that shoring in place and the additional cost for dewatering. The supplemental request will bring the total appropriation for the project to $875,000. Their city's notorious, so there's a lot of perch groundwater. Everything from manholes just sinking into the ground. So when we work out there and have to dig, which we had to do in this, generally we have to leave shoring and put in a pretty expansive dewatering. In this case, we needed a little more than what we anticipated, so that's for the additional dollars. All right, thank you. Next item is the Canterbury and Roland Sanitary Relief. This too is an appropriation for additional funds on an ongoing construction contract. The contractor is Aztec Construction. The work being completed on this project consists of construction of approximately 1,680 feet of sanitary sewers 8 to 15 inch in diameter and 680 feet of natural channel stabilization. The purpose of the project is to alleviate building backups and overcharged sanitary sewers and to alleviate yard and structure flooding in the 6900 block of Roland in the city of Northwood and Pasadena Hills. This supplemental appropriation is for $150,000 required to complete the construction due to additional costs related to the discovery of a collapsing storm sewer and pavement that was not part of the original scope of the contract. In addition, the presence of an unknown asbestos-coated gas line that was in conflict. We didn't have to replace it, but what we did is we extended it in a bore on one of our sanitary reaches to get past it and not have to deal with it. So we had an additional cost of about $150,000. With this additional $150,000, the total appropriation will be $1,530,000 for the project. Any questions? All right. Next couple items are CSO Green Infrastructure Grants. First one is a Green Infrastructure Grants for 4315 Evans Avenue. This ordinance authorized the district to enter an agreement with Vandevetter Place 2 Limited Partnership to provide financial assistance through the Green Infrastructure Grant for construction of green infrastructure. The purpose of the project is to reduce combined sewer overflows to the Mississippi River per the long-term control plan and consent decree. The project will reduce runoff with the installation of 4 bioretention basins on this redevelopment site. The total cost of the green infrastructure is estimated at $185,000, and the Vandevetter Place is requesting $185,000 reimbursement for the cost of this green infrastructure. There's a map in your packet. This is located in North City at the intersection of Pendleton and Evans. As you can see there, the redevelopment, and then they'll capture that storm water that runs off to Evans and onto the alley there into the rain gardens, reduce that overflow. Next one is a green infrastructure grant for St. Louis University Champion Center. This ordinance authorizes the district to enter an agreement with St. Louis University to provide financial assistance through the grant program, again, to reduce combined sewer overflows to the Mississippi River. This project will reduce the volume with the installation of 2 bioretention basins. The total cost of the project is estimated at $298,000, and they are requesting $298,800 reimbursement for this green infrastructure. And again, this particular project, there's a map in your packet, is located obviously on the St. Louis U campus just north of Forest Park Parkway and just west of Compton. It'd be just south of the big stadium there, or the can't think of the name of it, but the
Chaffetz Center?
Chaffetz Center. Thank you very much. So it's just south of that area. where they're building a new Champion Center. Any questions? Okay. Next several items are projects bid this last month. Advanced sanitary relief. This appropriates funds and authorizes staff to enter a construction contract. The work to be done consists of construction of approximately 340 feet of 12-inch diameter sanitary sewers. The purpose of this project is to alleviate overcharged sanitary sewers and building backups. The district received 7 bids on this. The low bid was from Gershenson Construction. The bid was just above our design estimate. Our appropriation of $215,000, which includes utility relocation and contingencies, is above our original budget for the project. Gershenson has committed to 17% MBE African American participation on the project, and that meets our current 17% goal. The next item is Abyssal Coldwater, Missouri Merrimack Public I&I Reduction Contract C. This appropriates funds and authorizes staff to enter into a construction contract. The work consists of construction and rehabilitation of approximately 38,000 lineal feet of sanitary sewers, 8 to 36 inch in diameter, using the cured-in-place pipe methods. The rehabilitation of 28 manholes and rehabilitation of 756 service connection and 4-point repairs on the lines. The purpose of the project is to reduce inflow and infiltration in the Coldwater Creek watershed. District received 2 bids on this project. Our low bid was from SAK Construction. The bid was below our design estimate, and our appropriation of $2,650,000 is just slightly below the original budget for the project. SAK are cured in place, our rehabilitation projects. We fund through grants through the state revolving fund. The MBE goal for those projects is 10% minority and 10% women. SAK is meeting that goal with a total of 20.11% MWB participation on the project. The next item is the Harlem City Shed Mitigation Basins. This action appropriates funds and authorizes staff to enter a construction contract. The work to be done consists of construction of 2 detention basins with a combined storage volume of 40 acre-feet on the 2 rain gardens, approximately 2,600 linear feet of storm sewers from 8 to 48 inch to get flow to those basins. The purpose of this project is to reduce building backups, alleviate wet weather surcharging and overland flooding of the combined sewer system within the Harlem City Shed of the Bissell Point watershed. The district received 5 bids on this project. The low bid was from Keeley Construction Group. The bid was below our design estimate. Our 2-year appropriation of $6 million with 4 years in fiscal year 23 and $2 million in fiscal year 24 is above the original 2-year budget for the project. It includes $250,000 for utility relocation and security lights on the premises and contingencies. Keeley Construction is committed to just over 17% minority participation African American, which meets our 17% goal for the project. Are there any questions? All right. The next item is the infrastructure repair annual appropriation for work at our facilities. That would be our plants and pump stations, small projects throughout the year that we bid through the purchasing division. This will appropriate $3 million for this work. The work to be done consists of construction of needed repairs, replacement, or improvement projects to address needs at facilities such as treatment plants, pump station, and other district infrastructure. This appropriation of $3 million is to continue the implementation of this infrastructure repair program at our facilities. Just some of the typical, right now, there is somewhat of a balance, but just some typical projects that we do is we're doing pump station generator replacement. So we've got 250 pump stations out there. You have generators that go bad. So this kind of funding is used to replace those. We're doing some security improvements now that we have a new security team here at Market and for our other facilities, we're improving some of our security at some of the plants. And it's everything from replacing wiring. We're putting in a bypass pumping portal at a treatment plant. So those are the types of jobs. They can range anywhere from 50 to 500,000, but it's just to replace different things that go out that aren't part of the capital program. All right. Next project is the Lima 1 pump station cooling tower replacement. This appropriates funds and authorizes staff to enter a construction contract. The work to be done consists of construction of 4 cooling towers at the Lima 1 pump station with appurtenances. The purpose of this project is to remove and replace cooling towers, pumping valves, and duct bank, which have reached the end of their useful life. The district received 2 bids for this project. Our low bid was from Corrigan Company. The bid was below the design estimate. The appropriation of $1.4 million is above the budget for the project, but we expanded the scope slightly to include a couple items for our water treatment system, and there were some needed electrical upgrades once we got in to do the design on the project that weren't originally included in the budget. Corrigan is committed to 30.94% MBE, which is African American and Hispanic. We have a goal of 30% on projects that we consider building projects, and this is considered a building project. And so they were able to obtain that just under 31% participation for the project. All right. The next one is for the Deer Creek Watershed Initiative. This appropriates additional funds and authorizes staff to enter into an agreement with the Missouri Botanical Garden. Missouri Botanical Garden received a non-point source implementation grant from the Missouri Department of Natural Resources under Section 319 of the Clean Water Act. Botanical Garden will partner with MSD under this contract and the Deer Creek watershed municipalities to consider a homeowner cost share to install plant-based green infrastructure management practices along Deer Creek. This agreement provides for reimbursement up to $100,000 to the Missouri Botanical Garden for costs related to the construction of green infrastructure. This is phase 5. This has been a multi-year program. It's funded through our Deer Creek OMCI. So that's a fund that generates a fair amount of dollars, and it's been a good project that we worked. Just a breakdown of the funding for the project, EPA and MDNR provided just under $600,000, and there's some other non-federal matching funds provided up to $305,000, and MSD's part is $100,000. So it's about $1 million project. So folks that are interested in doing things along their creek bank, some of the smaller tributaries, can participate in this program through Missouri Botanical Garden. So it's been a very good program for us. It provides, implementation, education, demonstration projects, and it's been a very rewarding project for the Deer Creek.
Do we do any other collaborative things with MoBot?
We do. We actually have our small grant program, both for the combined sewer area, and then we have a small grant program for the separate sewer area. Not as much money as we do on the small grants. This is September, probably in November. Then we'll be bringing the renew of that contract and appropriation of that money.
Cool.
So yeah. It's very good for us. Otherwise, we would have to they provide a lot of services that we would have to gear up and provide, and they're better at it.
Yeah.
So, any questions on that one? All right, the next one is the Longford Drive Storm Sewer. This appropriates funds and authorizes staff to enter a construction contract. The work to be done consists of construction of approximately 134 lineal feet of storm sewers, 12 to 24 inch in diameter. The purpose of this project is to alleviate yard flooding and potential basement flooding at 1851 and 1861 Longford Drive in unincorporated St. Louis County. We received a total of 7 bids on this project. The low bid was from Tailor Made Construction. The bid was just above our design estimate. The appropriation of $115,000, which includes utility relocation and contingencies, is slightly above the budget. Tailor Made is committed to 17.7% MBE African American participation, and also want to note that Tailor Made is an African American owned company, so we'll get 100% participation on this project. They're also one of our small sewer contractors as well. These projects in this range give them an opportunity to start doing larger work. So hopefully we'll see a few more of those. Any questions? All right, this next item is the White Plains Sanitary Relief. This is an ordinance that will authorize staff to proceed with further condemnation efforts, including the filing of all necessary pleadings and documents to the acquisition of permanent or temporary construction easements for 3. Your write-up says 4. We've acquired 1 more since we put this together. Easements and temporary constructions are needed to construct a project consisting of construction of approximately 852 linear feet of natural channel stabilization and 28 linear feet of sanitary sewers from 8 to 15 inch in diameter. The purpose of this project is to alleviate wet weather sanitary surcharging as required by the consent decree. This project required a total of 10 easements. We've got 7 to date. So there's 3 we're requesting approval to move through with condemnation to get the projects going. You have some maps there of the 3 parcels. The first parcel up, let me get my maps out. I can't quite see that up there. The first one is parcel 7. The status on parcel 7, if I can find my notes here. As we've set out offer letters, but we're having trouble getting those. They've been coming back to non-deliverable. We did find a good contact phone number, and the owner's currently out of town until the end of September. But we've had discussions with them. We do not anticipate going to condemnation, but we want to keep this moving forward in this particular case. The next sheet, Sharon. Parcel 10, we just can't get any kind of response from the property owner whatsoever. So generally when we, that's with sending letters and leaving door hangers on the property and trying to catch them at home. Generally, once we send the 60-day letter, generally they'll get back to us pretty quickly when they realize that we're taking the next step. And then finally, parcel 11, we've actually, at the time of as early as yesterday, it appears we've reached agreement to settle and wait an execution of the document. So there's a good chance by next Thursday, that'll be one less we'll have on there. But right now we have it on for my presentation. So it looks, there's a good chance we'll probably be getting all the easements on this, but again, we want to keep the project moving forward on schedule. And I know there's another one that I'll talk about after we get through the agenda that we had a question at the last board meeting, and I'll talk about that. Any questions on that? All right, the next one is a design supplemental for a design contract. It's a Lime wastewater treatment facility and improvements, drip tank, and secondary clarifier duct bank. This ordinance authorizes the district to enter an agreement with Donahue Associates for engineering during construction for the Lime wastewater treatment plant repairs and improvement project. The repairs and improvement is a lump sum cost for the design and preparation of construction documents to construct and repair the removal and replacement of various aging infrastructure components at the Lime wastewater treatment facility. The purpose is to renew the existing grit removal system replacement of buried electrical duct banks serving the secondary clarifiers, and repair aging concrete infrastructure primarily on tunnel interiors where the concrete is damaged due to leakage, seepage, and stress cracking. The construction cost estimate for the overall construction project is $9 million. This appropriation for this design contract for those engineering during construction, which they'll review shop drawings and answer questions from the contractors, appropriation of $400,000, which will bring the design contract to $1,310,000 for the project. MWBE for the consultant. This amendment, they plan on utilizing about 26.25%. Their original goal was right around 29.67%. After this amendment, they'll have a total utilization on the project of about almost 33%. For design contracts, there is no goal, so we'll be getting 33% minority and women participation on this design contract, and there is no goal. Any questions? Next item is a renewal of a services contract. It's stormwater asset investigations. This ordinance authorizes the district in amendment number 2 with Trek Design Group. The purpose of this project is to provide district staff with detailed information regarding stormwater systems by performing such services as project reconnaissance, field investigations of storm systems and structures, inspection prioritization, field verification, map updates, asset ownership, and work order management, and post-inspection review. These services are the basis for our district stormwater preventative maintenance and rehabilitation activities. After amendment and this appropriation of $800,000, the total contract will be $1.6 million. This is the first renewal of the original contract, and there'll be one additional year based on the performance of Trek. And up to this date, they've been doing a great job on this, providing us the information that allows our crews to go out and do the work that they need to do as far as repair and rehabilitation. There's no MWBE goal. They are providing about 38% minority participation with Gonzalez Company, and this firm, Trek Design Group, is a woman-owned firm. So again, we're getting about 100% MWB participation for this project. Any questions? All right, and this last item is not one you'll be voting on at the meeting next month, or this coming up next week, but we'll be bringing October for introduction and adoption. This project isn't new to you. It was an emergency repair number 70, Blair and Ferry. We brought that to you about 2 months ago. We've made the initial repair on the project, and we've stabilized, and the structure's been rehabilitated, and we've got everything in place. But during our removal or fix of this structure, the 2 large brick sewers going both directions, which have been rehabilitated with cured in place pipe, was done in the early 80s. So that's how long ago these pipes were rehabilitated, have both started. We refer to it as egging. In other words, they're starting to flatten out, and our fear is they're collapsing. It's about 15 feet on both sides of the structure. We don't know whether it was caused by the structure. So what we're doing right now is we're working with the emergency contractor on, we have a plan in place, and right now we estimate another $2.5 million. We want to get that price. I didn't want to bring it to you until we get that price situation. So what we'll do is we'll use one of the new structures we built to make the initial repair, and there'll be a tunnel project. It'll be about 60 feet of tunnel, and we'll go right around this whole area that we're having the problems in. So we'll have sketches and pictures for you when I come next month to the program management meeting, but I wanted to let you know that that was out there.
I have a question, Rich. When obviously these non-budgeted projects, when they're done on an emergency basis, the funding comes from the emergency fund. How much is in the emergency fund? And this seems like a big project.
It is. It's generally about 5 million a year, right, Marion? This is gonna pretty much deplete our money for the year, and we're only in the third month. So what we'll have to do probably at some point is bring to the board, to move some funds, right, Marion? Or we hope there are no more emergencies, but no, we do, if it's small, we do have, I bring the infrastructure repair funds, which is about 7 million. If we do try to take projects that we refer to as immediate needs that don't level, in other words, we're able to actually take bids. So we try to do as much out of that to save the emergencies for the real emergencies that this is. Which this one here, the issue here is it's a large sewer serving a large area in addition to 2 large water mains sitting right over the top.
This was this, wasn't there a cave-in on the street here?
Correct.
Yeah.
Yeah, and then once it was open, we were staring at 2 large water mains.
All right.
So that's all stabilized. Everything's been grouted all the way to the top. That structure is no longer leaking, but we need to fix those 2 sewers on each side of it.
I mean, it seems like there's no question we need to do the work. I'm just.
It
the
is.
Funding for other potential emergencies needs to be available.
We will have to, we'll have to more than likely appropriate additional money for in other words, we'll bring that to the board, don't we, Marion, when we make that transfer? Yeah. Thank you. That was a good question. So that concludes the agenda items. I do have one other item. At the last board meeting, we had one of the parcel number 78, that's owned by a gentleman by the name of Chow Ma, and indicated they hadn't had any contact before we sent the 60-day letter for the we requested to go to condemnation. There had been numerous contacts. This property owner didn't take ownership till late 2019, early 2020. There were some initial contacts during design. There were survey letters sent. There was a public meeting during the design. They weren't the owner. There was a virtual meeting earlier this year in 2022 that this property owner received a letter and an invitation to, but they obviously were not there. So we've immediately made contact after we received the letter. They've had 2 meetings. We've actually got the easement staked, so they kind of know where it is. So negotiations are going. In fact, there's a meeting this afternoon with them where we think we actually will get the easement. So that's the update on that.
So then are you going to be asking us to vote for adoption?
We will still, because there's an additional, we were, I think, seeking 35. After the letters were sent out, I think we had 15 of those property owners reach out, so we're in active negotiation. So we will still be requesting for you guys to vote on the adoption of that ordinance to move forward. But this particular property owner, and again, a lot of times that 60-day letter is because we are not getting any kind of response back from them about the easements. This particular project is there's going to be a lot of disruption. There's a lot of hard negotiations going on because their yards and the fronts of their houses and access to the homes is going to be disrupted for a fair amount of time. And that is all I had.
Thank you, Rich. Next tentative meeting date is October 4th, 2022. Can I get a motion to adjourn?
Thank you.
Trustee Farrer, with the time, as soon as we get documents sent out, we'll be ready to start when you are.
Okay. All right, this is the 282nd meeting of the Finance Committee of MSD. I trust the record will reflect that everyone is present other than Mike Evans. Approval of the committee meeting minutes from August 2nd.
Second.
Minutes are approved. I have no comments, so let's move to the pension quarterly performance update.
All right, thank you. On the line, we have Mike Comstock from Aon. Mike has been on the Aon team with us for a while, but he's recently taken over the lead. So he is our lead relation guy, and he has the unenviable task this morning of walking through this year's investment environment and performance. Mike, are you ready?
Well, yeah, with that opening, though, it's going to be tough. But yes, I am ready.
All right, you can start anytime.
All right, perfect. It looks like the screen is being shared. Thank you very much. We are going to be looking at data primarily through June 30th, although we do have some updates that bring you a little bit more current through the third quarter, and things have gotten better. So I guess that's my counter to Tim's comments there. But boy, things were really rough in the first half of the year, no doubt. And you can see that on page 4. We list major capital market indices that are relevant for you all in different ways. And in global stocks, for an example, you have 53% of the pension with a global stock orientation. And you can see what performance has been. The second quarter data shows down almost 16%. The 1 year number is down 16.5%. So again, when we look at the pension plan's performance, I want to help frame what that sort of opportunity set looked like. And global equities were negative in a pretty big way. And we'll get into some of the reasons why in a moment. The good news on global equities, if you look to the right of the page, still at the top row, quarter to date. So third quarter to date through August 19th, global equities are up 8.8%. So that's good. Things have improved. The other primary category for your pension plan is down on the 6th row where it says U.S. investment grade bonds. About 35% of the pension plan has exposure to bonds of varying durations, but this is a pretty good proxy. We'll look at the 1 year number there, down 10.3%. So in an odd environment where both equities and bonds were significantly negative, investors really didn't have a whole lot of reprieve. There were some areas, core private real estate, for an example, at the bottom of the page. Thankfully, you have a good chunk of your pension plan in this component of the market. It was very positive. You can see 28% 1 year return. And again, you have 10% of your pension plan in these real estate assets. So those 3 buckets are really the kind of the whole pie for your pension plan. Global stocks were definitely a drag. Bonds with rates rising the way that they did were a drag, but thankfully real estate offset things a little bit. And again, you can see to the right, third quarter to date does show a little bit of a better picture than what we saw for the first half of the year. The next page gets into why things are happening. And peaking inflation is really the biggest driver. Inflation, there's a lot of uncertainty with inflation, other than the fact that we know it's a lot higher now than it was 6, 9, 12 months ago. And it's affecting all of our lives in a lot of different ways. CPI, just broad inflation measure, at 8.5% last month. And there are some thoughts, I think it's as much hope as anything, that inflation is peaking and will start to subside. The Fed, and this is the real issue, the Federal Reserve is doing whatever they can to combat inflation. And the best way to do that is to slow an economy. And the best way to slow an economy is to raise interest rates. And the Fed's been very aggressive in that. Some say they were a little bit late when they started off their interest rate increasing campaign, but they're steadfast in that their view is that they want to get inflation under control, which means closer to 2%. And in order to do that, they're going to raise short-term interest rates to try to slow the economy and get inflation under control. So their Fed funds target's currently at 2.25% to 2.5%. The Fed is projecting that they're going to be raising those short-term rates to a level between 3.4% and 3.8%. So what does that mean? We have room to go on interest rate increases from the Fed. So you should expect to see that as 2022 moves on, that the Fed will continue to raise short-term interest rates in an attempt to sort of cool off inflation. And the goal is to not overdo it and push us into a strong recession. Job market remains strong. That's really good. The consumer is fairly healthy. There's some data showing that things might be turning on that with folks spending all their money on food and gas. Thankfully, gas prices are coming down, that they don't have enough money to spend on other goods and services. It's again, like I said at the outset, inflation is sort of a wild card. It's difficult to predict what's going to happen going forward. But those factors right there, rising inflation, the Fed's response, and the fear that we could end up in a recession is what's driving market volatility. And that's why you see those negative numbers on that previous page. Equities selling off and fixed income is negative because as interest rates rise, bond prices fall. That's why you're seeing that. On page 6, medium-term views. So we have a lot of modeling to project out what asset classes can do going forward, right? We have assumptions. We have long-term capital market assumptions, which go into an analysis to help frame what the long-term asset allocation of the pension plan should be. That's not this. This is looking at more near-term views. So medium-term views are 1 to 3 years out there. How do asset classes look from a valuation standpoint, from a momentum standpoint? And what we do is we try to keep this simple and we rank them either right down the middle. Equal means that asset class seems sort of fairly valued. We're not negative or positive on it. And then you can see the extent to which there are negative signs on the page here. So just look at the top, core fixed income. Interest rates rose so much that core fixed income doesn't look so bad anymore. That was significantly negative at the beginning of the year because rates were low and the idea was that rates were going to rise throughout the year. So our view on core fixed income was negative. It's improved. Equities and return-seeking fixed income, you can see they're to the left, one negative. So our view is that there's a pretty darn good chance we're going to be in a recession in the next 18 months. And assets that rely on growth, riskier assets like high-yield bonds and equities could face a little bit of a headwind. So we're not as positive on those. What we do like are alternative assets and even cash. With interest rates moving to the extent that they would, you are starting to earn something on cash, which is great. And then alternative assets, whether they be private credit, certain types of hedge funds, even real estate, those types of assets look better. So that's the overarching view on our medium-term views. And below that, you can see broken out by these different categories, how we look at different subcomponents of asset classes. I wasn't planning on going through this. I just wanted to frame kind of the big picture views that, our view is that the next 12 months isn't going to be easy, that equities could suffer and return-seeking fixed income could suffer as well, just given the uncertainty and the volatility that we expect. So moving ahead to page 8, with all that market backdrop, we can take a look at the pension performance. And, again, very challenging market with little room to hide. You probably aren't surprised to see a negative return for your pension plan for the second quarter as high as it is, down 10% for the 3-month period. You can see the benchmark return there of -8. We'll look at relative performance in a second. But the 1-year number down 15% against a policy of -13. And then thankfully some positive returns as we go to the right of the page here. You can see for the last 5 years, 4.3% annualized. So on average, what did the pension plan return net of fees? And again, that 5-year number has been brought down a lot by the first 6 months of 2022. Again, the DB plan, we've seen things improve in the third quarter, thankfully. The DB plan is up 5% in July and a bit more in August. We don't obviously have final numbers yet, but the DB plan's performance has improved since the end of June. 5% return in July. On page 9, we're looking at just historical market values going back 20 plus years and a nice trajectory here. Again, the idea of being a long-term investor is something where folks stick to their policy as long as their policy makes sense and don't make rash decisions by selling out of equities when there's fear and making sure that you rebalance. Things along those lines go a long way to have an asset growth that looks like what the picture is you're seeing here. So At June 30, $294 million in pension assets. Page 10 gets into more policy level. Are the monies where they're intended to be? And here you can see across your pension portfolio in green what the policy targets are for different asset classes, and in orange how much money is actually in there. And in blue we highlight what the difference is. So you're pretty much on top of your policy here across the board. Again, I opened this page by saying, is the money where it's intended to be? And I can sit here independently telling you that yes, it is. I'll pause for a second, just see if there's any questions. I'll get into manager level performance and show a little bit more data here, but any questions from anyone so far?
Not right now, Mike.
Okay, sounds good. So let's go to page 11. And here we're looking at the pension plan trailing period performance, again, still through 6/30, but now you can see all the different managers underneath that are managing different portfolios for you. So the pension plan at the top in dark blue, again, there's that 294 million. There's the returns that we looked at. Below that, you have domestic equity. So that is made up of large cap US equity, which is an index fund managed by BlackRock. That fund is designed to deliver the performance of the market. So the Russell 1000 index, that's a large cap proxy for US equities. And the BlackRock fund is designed to track it, and it has. And you can see its performance in line with expectations. The other domestic equity component is small cap in nature, so a little bit riskier as it relates to sort of volatility. You would expect more volatility in small cap names. Kennedy manages a value portfolio with more of a mid cap framework, and Times Square manages a growth portfolio, plays more in small cap. And you can see to the right, let's just focus on year to date. So what I didn't say at the beginning is for the last 12 to 18 months, value stocks have outperformed growth stocks. And that's a big turn in the market. Growth stocks had done so much better than value for years, and value managers were suffering. As interest rates started to rise, the sort of discounting of future revenues on growth stocks caused a big sell-off. And you can see that as an example, year to date through 6/30, look at the Russell 2000 growth. That was down 30% for the 6 months. The mid-cap value index, which is a little bit different in that it invests in slightly larger cap names, but it has a value orientation. That's sort of the point. That was it's down 16%. So value did a lot better than growth. And that's why you see Kennedy sort of outperforming Times Square over that year-to-date period, that 1 year period, because the market in which they invest was more favorable. So year-to-date, Kennedy was down 19% and Times Square was down 31%. Big numbers, but again, not out of line with expectations given what the markets that they invest in were offering. International equity, that was, as a whole, your international portfolio was down 20%, in line with, broadly speaking, how non-US equities did. Year to date, they were down 18.4. Again, you have two managers here as well. Morgan Stanley, they have two portfolios. One's more focused on developed markets, and the other is more focused on emerging markets. And the emerging market portfolio didn't do as well. That was down 26%. The developed market portfolio was down 17%. And again, across the board, all of these portfolios have delivered positive performance in July. So what you're looking at here really at 6/30 is sort of the depth of it. Things have been better going forward as we moved into July and now August, which is great. Page 12 looks at your fixed income portfolio, some residual hedge fund asset, and then your real estate portfolio. So again, fixed income, we're not used to seeing big numbers negative in fixed income, but the extent to which interest rates moved during the first 6 months of the year were extreme. I mean, look at things like, I know this isn't totally relevant, but look at what mortgage rates did. You know, you had mortgages under 3, and now they're pushing 6. That's just a good proxy for what rates did. The 10-year Treasury, as an example, was up 150 basis points. So all these fixed income managers didn't really have any place to hide as rates were rising across the curve, and generally speaking globally, as central banks began tightening, the returns were negative, and there wasn't a whole lot of starting yield to offset those price declines. Now we have better yield in fixed income portfolios, which is great, But we do have to look backward in the mirror here. And year to date, you can see down 10.6 for your fixed income assets. 3 different portfolios. Income research would be the most conservative. It's a U.S. government credit mandate. Prudential manages more of a broad-based U.S. portfolio. That's treasuries, corporates, mortgages, with a sprinkle of sort of some other type of higher yielding assets that Prudential has the ability to invest in. And then Brandywine's more global in nature. So there's going to be some non-USD in there. As the dollar rose, this portfolio suffered, right? The dollar rose significantly, kind of hitting at all-time highs. Our economy is sort of the best of a breed out there. And our interest rate increases were a little bit quicker than a lot of other countries. So the dollar has been following suit and has done well. So non-US exposures were impacted by that, and Brandywine wasn't immune. So again, really disappointing looking at this, backwards. But again, things have turned, and your fixed income portfolio has done significantly better than what you're looking at here in the third quarter, because interest rates really haven't moved too much since then. And then there's that real estate, UBS, 18% return over that 1 year period. Again, good diversification benefits, low correlation within real estate to equities and bonds. So that's what you like to see. You want to see an asset zag when others are zigging, and the real estate portfolio has done just that. So those are my prepared remarks on the pension plan. I plan to shift to the DC plans on page 13, unless there are questions.
No questions, Mike.
Okay, thanks, Tim. So here's just a summary of where the assets are on page 13 for the DC plans. You can see on the bottom right-hand side, over $100 million in combined DC assets as of 6/30. Page 14 gets into some of the performance, and you all are Vanguard across the board, which again, we hold them in very high regard. They manage your target date funds, which you can see on page 14. And again, these target date funds are designed to, as you're going from the top of the page, looking at say 2015, 2020, 2025, those are more conservative. Whereas when you go to the bottom of the page, you're looking at the 2055, 2060, 2065. They're more aggressive in that they have more equity exposure in them. So as an example, the 2065 fund has 90% equity. The 2015 fund has roughly 30%. So not surprising, equities did worse than fixed income. You're looking at more unfavorable performance as you go down the page there. Despite how difficult fixed income was, equities did worse. So, I know I'm not happy to see negative signs in front of all these, but these funds are doing sort of exactly what they're intended to do, for your participants. And again, the performance of these has improved in the third quarter as well. Page 15, we looks at what we call tier 2 and tier 3. So again, tier 1, the target date funds for investors that don't want to do anything but save, right? They just want to put their money away. The target date funds sort of do it all for them. Tier 2 and tier 3 are for more active participants. Tier 2 are index funds, where folks want to get very low cost exposure to different parts of the market. And then tier 3 are some actively managed funds, where folks might be willing to pay a little bit more to try to beat the market. So here's a look at how the performance has been for these funds. Year to date, again, not anything great here. The index funds are all in line with their markets. You have a large cap, a mid cap, a small cap, and a bond portfolio. And then a balanced fund, which is a mix of predominantly stocks and bonds. And then tier 3, you have funds that play in different components of the market, both US and non-US. And frankly, year to date, pretty disappointing performance in absolute and relative terms here. A very, very difficult market for active management. But you can see there the Windsor Fund was down 17%. The US Growth Fund, remember how bad growth stocks did generally? Not surprising to see that fund be the worst on the page here, down 38%. And then the International Growth Fund was down 31%. And then the last two are just more conservative sort of capital preservation vehicles. And that's exactly what they did. For folks that don't want to have market exposure and just want to preserve their capital, those two Vanguard funds at the bottom are options for them. So Tim set it up, really difficult, first 6 months of the year. And that's what the data we're looking at on this page. Disappointing to see, but again, the good news is that the market has turned and things are significantly better than they were as of this date, where you have market performance up, near double digits actually in equity markets, which has been good. And so all of these funds are seeing absolute performance positive for the third quarter so far. Okay, I'm going to cover 2 more pages, and it's going to make sure that we are being good fiduciaries and making sure we're looking at fees across all your plans. So page 16, what we're doing here is we're looking at the pension plan, all the different funds, the exposure, and then what the fee is, sort of in the middle of the page here. You can see fund expense ratio in percentage terms is what I'd be looking at against institutional peer comparison. So institutional quality funds, what's the median fee for those? And that's what we're comparing your lineup against. And as I go down, these 10 or 12 funds, I can conclude that fees are reasonable across the board. You're not necessarily lower than the universe median in every category. So more often than not, you are. But every fund, even the Morgan Stanley international equity and emerging market funds, which are 2 outliers as it relates to being higher than the median, they're still very reasonable. So from our view, there's no concerns with the fees that you're paying to have these underlying investment managers manage assets for you. And we proved that by showing what the universe looks like. On the DC side, I kind of similar story, but maybe even better. I would say fees here are not just reasonable, but low. And you can see how your fees stack up against the universe median, and you're pretty much lower across the board. That doesn't come as a surprise, right? Vanguard's model is low cost. So that's what you're getting. One of the things that you're getting from Vanguard. They're a great shop, but the fees and the funds that they offer are low. And that's one of their business models, is they use their scale to bring fees down. And you can see sort of the proof point here when you compare the fund expense ratio to what the universe median is. Things look pretty good. And again, the word reasonable is important. We would conclude that the fees are reasonable. I'll stop there. There's an appendix that just shows some other data for peer data, but I wasn't planning on going through that. That's there for your absorption if you'd like. I'll take any final questions.
Any questions? Nope, doesn't look like there are any questions, Mike. Thanks so much for your time this morning.
You're welcome, Tim. I appreciate it. I'll talk to you soon. And thank you, everybody.
All right, thanks, Mike. All right, is it all right if I move to the next couple items?
Please.
All right, next item is a proposed resolution. I have 2 proposed resolutions coming up next. The first one is for Ann. So you just heard from Ann, our pension investment consultant. They're about to head into their 5th and final year of our contract, so I recommend that we do renew for the 1 year, and then we will, in the next, in probably less than 6 months, put an RFP out on the street for a new service provider. They're welcome to obviously respond and could win the business again, but we'll take a look at a number of different respondents, and we're going to look at some different kind of models probably. So what they do is a traditional consulting role. They also offer services, as do other providers, for something called an outsourced chief investment officer, which is something that we looked at last time. And that is something where they take a little bit more control of the portfolio. Right now, if we wanted to make changes, we would go through some education process. We would do manager searches. It takes, a long time to make changes. Here, if they were and I'm not advocating for this at this time, there's pros and cons. It's something that we'll talk about if we get enough respondents that are think that would be a good idea. But the outsourced chief investment officer, they can make changes more on the fly, and so it lets them adjust to market conditions and that sort of thing. And there's low fee ways to do that as well. So that's something I think we'll be talking about probably in the next year. But at this point, the easiest thing to do is to approve the resolution to renew their contract for 1 more year, and then we'll do the RFP over the next year. Any questions about Ann? Then also just sticking with pension, Milliman is our actuary, so they perform the actuarial evaluation every year as well as some accounting. reports. They also help us with our benefit calculations. They've done a good job. They've been our actuary for a long time. They're also going into their final option year of the contract, so we recommend renewing that as well. And then we will again do an RFP for those services as well in the coming year. Any questions about Milliman? All right, so the 2 RFPs to look forward to next year. And then, oh, it's still me, sorry. The portfolio review. I was ready to turn it over to Marion. Portfolio review is the page we look at every month. This goes through our investment portfolio. I'll start in the upper left. Par amount, $723 million. That's not significantly changed from last year, or last month, I'm sorry. Inflows and outflows were relatively stable. Interest rates have been rising, so we put a little bit of new money to work. There was some turnover in the portfolio, I should say, just a little bit. So our yield to maturity only went up about 3 basis points. The portfolio is up to 3.31. That's up 24 basis points. That's because the whole portfolio turns over every month. So that would be the latest 1 to 3 year blended treasury rate, whereas we just had a small portion of ours, so we only capture a portion of that since only a portion of our portfolio turns over. Our weighted average maturity went down slightly from high 1.2s to just under 1.2. Benchmark stayed about the same at 1.8. Credit quality is good. Generally, we stay shorter because we use some of the funds that we have invested, and so we stay a little bit shorter than the benchmark. Over on sector allocation, that's the one that just shows we're in compliance with our policy. So every investment that we have is within the policy limit. Nothing's out of the ordinary, neither the fund summary at the bottom left or maturity distribution at the bottom right. The biggest thing with the maturity distribution just shows you the difference of where we're invested versus where the benchmark is invested, which helps explain some of the differences that we see in the, for example, weighted average maturity. But we're in compliance with the portfolio. We're watching rates. They're moving around quite a bit, but that's good from an investment perspective. Hasn't been so good good for the short-term investment perspective as we put new money to work. Not so good for the pension plan as we just saw, and not so good for borrowing rates when we go back out to market again either, though we have no immediate plans to do that anytime soon. If there's no questions about that, the last couple of items are Marion, so I'll turn it over to him.
Thank you, Tim. Good morning. The next item on the agenda relates to collection litigation services that the district uses. We bid this service out about 2 years ago. So there's a resolution that the board will be asked to consider at its next meeting, which authorizes the second of 4 option years with 3 collection litigation firms that we use. The collection litigation attorneys are the last step in our collection process with respect to the collection of delinquent debts. We initially use first and second placement collection agencies. If they're not successful, then we utilize these collection attorneys. And so again, this resolution is asking for approval to exercise the second of 4 option years. Are there any questions I can answer? Okay, I will move on to the next item, which is our fiscal year-end FY22 budget transfer request. So as part of our year-end activities, we look at all of our funds to make sure that we're going to have positive fund balances in each of the funds. If not, then I bring a transfer request back to the board. We're not asking for permission to spend more money. We're simply moving budgets from one fund to another fund. And so the largest item that you'll see on here is a $9.1 million transfer request from our fund 6839. And this was a bond fund. It had to do with the refunding that took place in May. We don't budget for refundings, and so I always have to come back when we have these types of transactions. So we had $9.1 million of principal and interest payments that I had to book in our financials for FY22. So I'm actually reporting that to you now, but I need authorization to pay the principal and interest. I have booked the entry. Now I'm coming back to you with the request to book, or I'm sorry, to actually pay that principal and interest. So again, these are refunding bond issues. So I'm taking money out of the escrow account that we got when we issued the bonds, and I'm putting that into a debt service account. These are the accounts that we use to pay the principal and the interest payments. That's the bulk of the transfer request. There are two other small amounts, $2,000 and $200 that we needed to transfer to a couple of other funds to make those positive. Are there any questions that I can answer? Okay, thank you for your time. Those are all the agenda items that I have.
Thank you, Tim. Thank you, Marion. Our next tentative meeting date is October 4th. Is there a motion to adjourn?
Move.
Meeting is concluded. Thank you.
Trustee Wilson will change things out as quickly as we can.
Thank you. I'd like to welcome you to the September Stakeholder Relations Committee meeting. Can I get a roll call?
Yes, we'll note for the record that all trustees except Chairman Evans are.
Thank you. I have no comments. Can I get a motion to approve the August committee minutes? Thank you. Without objection, the minutes are approved. We have a light agenda, presentation by Mr. Berthol. Good morning.
Good morning. Thank you, Trustee Wilson. Good morning, other trustees. You should have in front of you a brief presentation labeled Semi-Annual Regulatory Compliance Report. This is a report we look at twice a year, obviously, and it goes over some of our plant metrics and service level metrics. If you'll turn to page 2, we're going to talk briefly about how we've been doing with our treatment plant compliance with regards to our discharge permits, talk a little bit about customer service, and then go through some of our service level metrics for our collection system. With that, if you'll turn to page 3, please. This is a summary of the past several years, as well as how we're doing for the first 6 months of 2022. And you'll see all the plants have had perfect compliance except for the Bissell treatment plant, and I just want to talk to that a little bit here. We have a pretty complicated project going on at the treatment plant. It's the rebuilding of all of the trickling filters, so we're actually pulling the plastic media out of the trickling filters, replacing it with new, and rebuilding the distribution arms that spray the water over the top of the trickling filters. And it's been a very difficult process to balance the flows through the plant, either through the trickling filters that are in service or through our blending operation. We have been in full communication with the Department of Natural Resources. They know exactly what's going on and what's taking place. But you'll see the 4 violations there are for solids, and it just has to do with how we've been managing the flows through the plant. The project is currently on schedule. We've had some difficulties with some deliveries for some of the media just because of the global supply chain issues, and have had to go through a number of conversations there, but we're doing fine. We've just had a few violations. Okay. If you will look on the very right-hand side, very proud to present how the other plants are doing. They have perfect compliance. Platinum Award, you have to have at least 5 years of perfect compliance, and you'll see 4 of our plants currently have that, and that the Coldwater and the Lemay plants are hopefully going to get there in the next couple years. If you'll turn to page 4. I'm happy to tell you that we had a very relatively dry first 6 months of 2022, and it reflects in how quickly we've been able to respond to our customers. You know, our goal is when someone calls us, calls our customer care group, we want to be out to that customer within 4 hours of the telephone call. And we were able to do that 93% of the time. I'm going to tell you with the rain events that we had in July 26th, 28th, and August 4th, that's not going to be the case for the second half of the year. But very good first half of the year. If you'll turn to slide 5. This has to do with our maintenance-related building backups. Our goal is to have less than 210 every 6 months, and we had 166. So did very well there. If you turn to page 6, our maintenance-related overflows, these are dry weather overflows that occur. For the first 6 months of 2022, we only had 66, and our goal is to be below 80. And that's based on the miles of pipe that we have in the system that we calculate that metric. If you turn to page 7, this summarizes our capacity-related building backups. These are the overcharge mains that occur when we have rain events. So for the first 6 months, we had 194. You'll see the rainfall line there. We had 21.12 inches of rainfall, pretty typical. So nothing out of the ordinary there, except for we did have one significant event in May that accounted for 179 out of the 194. Overcharges. If you go to page 8, we'd like to report on how many sanitary sewer overflows points that we still have constructed overflow points. And at the end of June, we were down to 51. Our goal by the end of 2023 is to be down to 35. We've had some, the recent rains created some issues, but we're still, we believe, on target to meet that. But we're down to 51. And just keep in mind, we used to be many years ago, probably had 600 or 700 of these. And like it notes, we started the consent decree at 206. If you'll turn to page 9, of those 51 constructed overflows, for the first 6 month period, only 16 of those actually activated or saw an overflow occur. All of our overflow points are monitored by electronically monitored, so we know when they activate, and we monitor that and track that. And then the last page, page 10. I like all the green for the first half of 2022. We're doing very well for that 6 month period with regards to our metrics. But like I said, we've had a little rough go here in July and August, and we'll probably see some of this change. Are there any questions I can answer with regards to this? Okay, well, thank you, Trustee Wilson.
Thank you. That concludes the agenda. Anyone have anything for the good of the body? If not, I'll entertain a motion for adjournment.
So moved.
Second.
Thank you. That is, meeting is adjourned.
Thank you, everybody.
Thank you.
Everyone.